Well, we're paying the price for all that free money that happened over the last decade, and now things are starting to catch up. It's like the tighter you pull a rubber band, the faster and harder it's going to snap back. And then when we look at all the geopolitical situations, especially in Israel right now, them being so close to the fuel sources, the oil sources, the ramifications and ripples through the economy with Ukraine, that being such a big energy source. So energy is big, plus with Ukraine and their grain, that has ripples effects as well. So we're not holding a good card hand right now.
You're listening to Kerry Lutz's Financial Survival Network, where you get valuable information you just can't find anywhere else. To thrive in today's trying times, you need the Financial Survival Network, now more than ever. Go to financialsurvivalnetwork.com and get your free newsletter and gift. Financial Survival Network, now more than ever.
And welcome. You are listening to watching the Financial Survival Network. I'm your host, Kerry Lutz. And hey, it's Thursday, October 12th. We just got the PPI numbers yesterday and the CPI numbers today. We're talking to Brad Williams to get his take on it. And you can find Brad's site, askbradwilliams.com. If you got a question or comment, what you think? Do you think inflation's going higher, lower, sideways? Just send us an email with your thoughts and anything else. KL@kerrylutz.com. Hey, Brad, great to have you back on the show. So we get the CPI number. What's your take?
Well, we're paying the price for all that free money that happened over the last decade, and now things are starting to catch up. It's like the tighter you pull a rubber band, the faster and harder it's going to snap back. And then when we look at all the geopolitical situations, especially in Israel right now, them being so close to the fuel sources, the oil sources, the ramifications and ripples through the economy with Ukraine, that being such a big energy source. So energy is big, plus with Ukraine and their grain, that has ripples effects as well. So we're not holding a good card hand right now.
No, we are not. So what is the solution for an investor? How do you protect yourself against what's happening here?
Well, I think, if you're very young, this is an opportunity because as prices drop, you're buying at a discount. The problem is I deal primarily with retirees, and they don't have that time to make up when they take that risk. So looking at income sources, looking at alternative sources of investment that do good in times of high inflation, that's key.
Okay, so what first, just let's review the numbers because many of you out there might not have seen them, might be unsure of what it is. What did we see here?
We saw a significant rise this month in the core CPI, and energy and food were two of the big drivers there.
Mm-hmm.
And now as we're seeing the inflation, then we're going to have the issue of the Federal Reserve raising interest rates, and then that crowding out individual buyers from the financial markets because the government's going to need more money to pay interest on the debt. We're looking at possibly a $2.2 trillion deficit.
Jeez, that's that's a lot of money, isn't it?
Well, Everett Dirksen said many years ago, a billionaire, billionaire, pretty soon you got some real money. Well, I think we're long past Everett's numbers.
Yeah, I think we're at $1 trillion here and $1 trillion there, and pretty soon you're looking at some real money, right?
That's correct. And then when you look at, the things happening at the border, Kerry, investors who are at or near retirement need to play it close to the vest, and they can't play by the same rules that got them to the game.
Right. And those rules, what were those rules and why don't they apply now, Brad?
Well, when you have, your typical 70-30 stock bond portfolio, if you don't own the individual bonds and your bonds are in mutual funds, you've pretty much gotten cream. If you own the bonds yourself, which we do for our clients as individual managed portfolios, you at least have a maturity date where you get your money back. But in a mutual fund, you don't own the bond nor the interest rate, so you get creamed in times like this.
Right. Yeah, you're getting killed, right? So you want to stay away from bonds, or do we go to short-term bonds?
Well, shorter term, or if you're buying bonds for the income that you're going to get from it and you're satisfied with that income, then you just ride out the storm and the fluctuations. It'd be the same as if you bought a rental property and maybe the neighborhood went through some changes, positive and negative, as long as you're getting that rent and you're getting money on your money, you're good. It'll eventually come back, but, it's that short-term fluctuations that you got to avoid.
Yeah, that can definitely hurt. Hey, so the short-term fluctuations, but, it's a lot trickier than that. I mean, what are you supposed to do here when inflation's going up? The economy is looking real bad. How can you really protect yourself?
Well, having a portion of your assets, obviously in precious metals, is one hedge. But you've always got to look at those precious metals as what they really are. They're an hedge. They're not an investment. If you want to make money on the metals, you buy the paper and trade the futures and options. But if you're wanting to hold value on your portfolio, then you own the hard metals to do that. But you don't want to go out and cash out your IRA and put it all in gold. Having some of that after-tax money sitting around as a hedge will help you during times like this. And then looking at more conservative income-oriented investments is good.
Mm-hmm. Okay. So, all right. And what age are you that this is particularly important?
Well, you might look at your life like climbing a mountain. You've got the accumulation stage where you're climbing and the distribution stage where you're coming down the mountain. Most deaths happen on the way down. So and then in the interim, you've got that preservation stage where, say when you're 55, you need to start de-risking. And then once you hit 60, you're probably in that 5-year preservation stage where you're shifting over to the income. I look at things like a simple formula, TR equals I plus G. Total return equals income plus growth. And so as you get into retirement and close to retirement, you're shifting to the I, which is income, and away from G, which is growth, because G can turn into L, which is loss. And so what you don't want is what happened to a lot of people in 2000, 2003, and 2007, 2009, where they had to delay their retirement because there was a massive market drawback.
Mm-hmm. That's kind of a drag. So are you telling people to keep working longer, to keep finding new ways to get cash flow besides from their investments?
If you like your work and your health is allowing you to do that, probably working a little longer than you expected in this environment might be a good idea, because then you're still putting money in your reserves and not taking it out. Even when you take it out, I always use the equation of you want to live off the eggs and not the chicken. So the dividends, the interest, that's what you want to live in. You might want to look at guaranteed sources with the interest rates where they are. Certain annuities are very popular now because of the inherent guarantees they have. So sitting down with an advisor who really understands the I phase of your life is important.
Yes, very important. All right. So your clients, what do you do? Obviously, you review them regularly, and I assume you're giving advice along these lines?
Yes, I am. And a lot of them are already there. In fact, Kerry, when we go through times like this, I don't get a tremendous amount of panic phone calls because they're ready for it. They understand the implications of the economy, and that the key is you want to be able to ride the wave. And you got to be structured properly to do that, or else you're going to lose sleep.
Yep, I can totally understand that. And well, hey, so what, with one more interest rate increase ahead, is that baked in the cake already, the markets and everything else?
I think so. I think it pretty much is. Where the anomaly will come is if they decide to go up again because of geopolitical things.
Right.
But, typically by the time the interest rate happens, it's already, like you say, baked in the cake. People have already anticipated that.
Mm-hmm. All right. Well, hey, thanks for giving us this update. AskBradWilliams.com, best place to find you.
Yes, and I always appreciate coming on your show, Kerry.
All right. Likewise, we love having you, and be well. We'll talk to you again soon. Hey, if you got a question for Brad and myself, KL@KerryLutz.com. That's the place to send the email, and we'll be having you back on next month, Brad. See what they do then. Will they raise or will they cut? I think a lot of it's going to have to do with the geopolitical situation here, isn't it?
Yes, it is. Yeah, right now it's the state of flux is probably a good term.
All right, state of flux it is. We'll talk to you soon, Brad. Thanks.
All right, Kerry, thank you.
Thanks for listening to Kerry Lutz's Financial Survival Network, your solution to today's trying times. For the latest, go to financialsurvivalnetwork.com. Financial Survival Network, now more than ever.